In this lesson, we will talk about long-term financial planning through the lens of investments. So by the end of this lesson, you'll realize the value of making pre-tax contributions towards your retirement as opposed to after-tax. You'll understand some of the different contribution plans available for retirement planning, and you'll know the main investment classes and the pros and cons of each of those. So first of all, I'll start with 401k plans. This is a workplace retirement account. It's usually part of a benefits package for you where you get to take a pre-tax deduction. And the great news about that is it lowers your income taxes by doing this before taxes. Free money is available in many cases because your employer will match what you put in. Okay, sometimes they match less, sometimes they match the same, sometimes they put in a little bit more than that. Okay, so one thing to consider is in 401k plans, a lot of companies will have you vest first. You've got to be at the company a certain number of years before they start doing that or before it's accessible to you. If you change jobs though, 401ks typically move with you, so you're not locked into one company because you've been there for 5 or 10 years. All right, and of course the money you invest, you can manage it to some degree, and it's tax-free. This asterisk means that there are penalties if you take it out before retirement age, if you had an emergency or something like that. Okay, 403b is a option for public sector employees. They can supplement their existing pension if you had CalPERS or CalSTRS, and this is sometimes called a tax sheltered annuity. This comes out before taxes. It's a great way to reduce your income taxes and add more money to your retirement funds. And in this case, the employer doesn't match it because you typically have a pension system that's already going, like CalSTRS or CalPERS. Okay. This stays with you if you change jobs as well. So there's some tremendous benefits here, and these grow tax-free as well, as long as you don't take it out early. All right, other forms are individual retirement account. This is where employees can contribute an additional sum each year. If you don't have a 401k plan, this can be a tax deduction as well. These grow tax-free. Again, early deduction or early removal has some penalties. And you can also do an after-tax plan. That's called a Roth IRA. So you can contribute, but it's from after-tax dollars. And these don't have any prepayment penalties because you've already paid taxes on them. If you're self-employed or you work for a small company, okay, you can contribute to a Keogh plan where up to 25% of your annual income can go up to $47,000, and so this also can grow tax-free again with those penalties. So all kinds of different plans. This is because the government, the IRS mainly, wants people to have various options to plan for retirement so that they're not all trying to pull from Social Security. Let's look at some numbers here. Let's talk about the value of pre-tax deductions. Remember what we said about your salary. Let's assume right out of college you're making $44,000 a year. I looked at the IRS chart, and actually the exact dollar amount for that salary would be about $6,923. State taxes for California would be $1,730. So you subtract these two numbers, you got $35,300 in net pay. That's your take-home pay if you don't do any deductions pre-tax. Remember we talked about $500 a month would be a nice number. Okay, that's $6,000 a year. If you took $6,000 out after taxes, you're going to have this much money left over, disposable income, to pay bills, to do all that. Okay, $29,000. What if you took out that money before taxes through an IRA or a TSA or something else like that? All right, or your 401k plan. Your $44,000 salary minus $6,000, you're only taxed then on $38,000 a year, and your taxes go down dramatically. So your net pay is actually $31,300. So notice that's almost $2,000 difference. How can you have the same dollar amount put into a retirement fund and have it cost you $2,000 less? It's because you're doing it before taxes. The government wants you to save early. They want you to have this tax benefit because they want you to start saving and growing that money early. So you can do it after tax and you have no strings attached. You can go pull that money out whenever you want. But really, I think that's a disadvantage because you might pull it out and spend it. You put this money in before taxes, it's going to sit there. You're planning for retirement. This is a great decision, a huge money-making decision. You're getting a $6,000 benefit at a $2,000 discount. So really, this is a wonderful thing for you to consider. Okay, how do you save $2,000? This much money less in federal tax and this much money less in state tax. Something to think about. And strongly recommend you talk to a financial advisor about doing that because it can really save you a lot of money. That's $2,000 each year it could save you while building up $6,000 a year in your retirement account. Now let's talk about various investments. Remember this slide from an earlier lesson, right? We had savings options with these low interest rates but low risk. very, very liquid. And we're going to talk about some longer term investment options that sometimes are liquid, higher risk, but higher returns as well. So let's talk about these, right? CDs, reliable and safe, low interest, and they have a maturity date that you can choose. These are great for savings if you don't need the money right away. If you know you're not going to need it for a year, go get a CD. You'll make a little bit more than your savings account. Money market funds have not been doing a whole lot lately, but they maintain a value of $1 per share by investing in short term. They're very risk free as well. Savings bonds are probably a little bit better. They'll give you a fixed interest rate for a fixed period of time. And all of these are pretty safe. They are investment options, but you're not going to make a lot of money. It'll barely, maybe not even, keep you up with inflation. Okay, so low rates, this is good for short-term money, but it's not going to get you too far. Mutual funds are something to consider, right? It's a pool of funds made up of stocks of various companies, all right, and they are usually classed by technology stocks or European stocks or American stocks, small companies, big companies. There's all kinds of varieties of mutual funds. There's tens of thousands of them. You get access to a fund that is managed by a professional financial manager, and he invests in a large variety of companies. So what this does is you have lower risk than stocks, because if one company went down because something happened, there was a lawsuit or the CEO died in a plane crash, you're not going to kill the whole mutual fund because the money is spread out amongst dozens and dozens, sometimes hundreds or thousands of companies. All right. So they have slightly lower returns than stocks in general, not always, but in general, and they're lower risk. That's a great place to start for young investors. An index mutual fund is a fund that tries to match a stock index, kind of like the S&P 500, the Dow 30, or the Wilshire 500. NASDAQ 100 is tech stocks primarily, but these index funds will try to mimic some of these indexes, and studies have shown that this is a great way to balance risk and reward over time. If you want to go pick stocks or pick mutual funds, more power to you. But picking stocks has often shown that you can't pick winners all the time. And so that just sticking with index mutual funds is a very safe, almost a no-brainer way of investing very wisely. And so that's something for young investors to consider. Again, talk to your financial advisor, but I'd seriously think about putting money into index mutual funds and just letting it ride for a long, long time. All right, stocks, these are the sexy ones because you can purchase ownership shares in a specific company. Like suppose you wanted to buy Apple stock, okay? You'd buy it at a stock exchange. You can do it online. You can do it over your phone. Prices change constantly, so maybe you buy it on a dip when the price goes down and hope that it goes back up, all right? So suppose you bought 10 shares of Apple. Let's just say it was $100 per share. It's less than that right now, but let's suppose you bought 10 shares times $100,000 is what you're going to invest. 2 years later, it went up to 120. So you get 1,200 back when you sell those 10 shares. You've got a profit of 200 bucks, and that's a 20% return on investment. I just take the 200, divide by my initial investment of 1,000, and that's 0.2 or 20% ROI, they call it. Now keep in mind, you got to pay taxes on that $200, okay? So there are tax implications when you have a gain. There's also tax savings if you had a loss, and you can carry those losses forward, okay? So notice that stocks are volatile. They can change a lot within an hour, let alone a day, and they carry the most risk of any of these main investment classes we're going to talk about, but they also bring the biggest potential reward. So the more risk you take, the more potential reward, but it also means you could lose a big chunk of your money, and in some cases, you could lose all of it. So just be aware of that, all right? Once again, young investors, seek financial advice from a professional. Certainly start with your parents and consider mutual funds as a first step because they're less volatile, less risky. You can invest in bonds as well. This is where companies issue debt by selling bonds. They'll sell you a guarantee of paying your money back plus interest. Okay, so they usually carry a fixed interest rate, not always, but they'll pay interest twice a year in most cases. And at the end of the term, if that's a 5-year bond or a 10-year bond, you'll get all your money back at the end of the term. Plus, you're getting interest that whole time. Okay, so let's suppose you bought $5,000 worth of 5-year bonds through a city. Cities can issue them, companies can issue them, and that's a wide variety of bonds you can issue. Okay, suppose it's 4% interest. Here's how it works: $5,000 principal, right? Principal times interest times time. $5,000 principal times 4% interest. You get paid twice a year, so it's half a year. You'd get $100 interest every 6 months. And at the end of 5 years, you get $5,000 back. So bonds can be pretty safe, very predictable cash flows, very good investment to balance out stocks because they're less volatile. They don't usually have as much potential gain, but they're more stable. Okay, so it's safer and steadier, less volatile than stocks. And it's a good balance to your stock portfolio. All right. Bond prices do change with interest rates. If you're locked in at 4% interest and rates go up, well, your bond isn't worth as much anymore. You'll still get your 5,000 back, but that's how bond prices change. If interest rates drop and you're locked in at 4%, you're happy. Your bond price will go up because it's worth more if interest rates are lower than 4%. This chart will tell you the long-term historical return on these different types of investments. Okay, if you look at small company stocks, since 1926 or 1925, I think, they have gone up quite a bit. If you invested $1 in small stocks in 1926, it'd be worth almost $10,000 today. And at the time of this chart here, about 2009, the stock market took a big dip because the Great Recession had just started. Okay, even large stocks, they're growing at close to 10% per year on average over the long haul. All right, bonds, not quite as much. Treasury bills are very safe, but they barely keep up with inflation. And let's not forget, this gray path down here is inflation. Okay, so what was $1 in 1926 would now cost you $12 to buy the same goods and services in about 2009 here. Okay, so you've got to beat inflation. The best way to do that is with stocks. Notice how stocks have returned more than everything else. This chart doesn't include real estate or other investments like commodities, buying in gold or platinum or crude oil. Those tend to be even more volatile than stocks. But you want to take a look at these things for a couple reasons, right? Stock market crashed in 1929 very sharply. You could have lost a huge percentage of your money at that time. Great Depression, it didn't do very well. Late 60s, early 70s, stock market did not do well at all. Then it rebounded and it came back. 1987, there was a crash. Okay, a lot of wealthy people bought in right after the crash because they think it's a great time to buy. Okay, 2000, there was another crash when the tech bubble burst. Okay, so here's a crash again. Now the Great Recession has brought stocks down again. What this chart isn't showing you here is through 2014, the stock market rebounded and is at an all-time high. So think long term. Look at this trend. It's pretty sharply upwards, and you're not going to get 8, 10, 12% from your bank by sticking it in a savings account. The key to making your money grow is to take some risk, but do it wisely. Understand that you want to stay in for the long haul. Okay? So what does this look like if you're young and in your 20s? Well, you can go heavy into stocks because if the market crashes, it'll recover. And actually, a great time to buy is when the market dips. But really, you should be putting money in steadily, not all at once. You cannot time the market. Tons of research will show that. If you can't buy real estate yourself, you can invest in real estate funds, mutual funds that go for real estate. So you can invest in real estate without having to buy a piece of property yourself. And of course, you can invest in a wide variety of bonds. So you should be heavily invested in stocks at the young age because you can handle the risk. Okay, as you get older, you want to slightly decrease your amount that's in stocks and go a little bit heavier into bonds. All right, so the reason for that is you'll have more time for the market to recover if there was a stock market correction or a crash. Okay, so don't be afraid of those things. They're actually great buying opportunities. As you get older, your mid-50s, notice you've reduced your stock portfolio even more, and by the time you get closer to retirement age, you should reduce your stocks quite a bit, and notice the heavy emphasis on bonds because bonds are very safe and predictable compared to stocks. Okay, so these are things to consider because you want to take less risk as you get close to retirement age, but at a young age, you can take more risk and your portfolio should be more heavily invested into stocks. One other factor to consider here is that you've got to have diverse investments. Don't go all into tech stocks or don't go all into consumer stocks. They're all American stocks. They're all small company stocks. You want to invest in some foreign mutual funds. You want to invest in some local mutual funds, small cap, mid cap, large cap. Because if one part of your portfolio grows sharply, suppose you went in tech stocks and they grew a ton, they doubled in a year, then a disproportionate amount of your portfolio is invested in that one area, and it could crash and really hurt your portfolio. So what you want to do is redistribute the money regularly so your portfolio remains balanced. Okay, one horse that runs out ahead of the pack is not always going to stay in front of the pack. The other horses are going to catch up at some point. So diversification is critical, and rebalancing is something you need to do regularly. Again, talk to a financial advisor. Even if that person costs you $100 an hour and you talk to them twice a year, they might save you $500. So $200 a year is well spent if someone can save you hundreds of dollars or thousands of dollars a year. Think about it. You'll be way ahead. Okay. So we believe you're going to be successful. We believe this course has taught you to save money early and invest it wisely, but it takes time. It takes steps. It takes discipline. It takes you not choosing to spend money on things now so that you can enjoy a tremendous benefit later. We expect you to be successful, and I think you will be. My last question for you in this course is, what are you going to do with your success? You can't take it with you. You can't fit all this stuff into your casket, okay? And I've heard a saying that my grandpa had saying, I've never seen an armored car at a funeral. So what do you do if you're super successful? What do you do if you're very wealthy at the end of your life? Well, once again, as we've said throughout this course, do what the wealthy do. They give back to charity. One person we've quoted in this class quite a bit is Warren Buffett, the second wealthiest American and one of the wealthiest men on the planet. Years ago, he challenged the billionaires of the world with what he calls the giving pledge. This is where the billionaires like Richard Branson, the British billionaire, Michael Bloomberg used to be the mayor of New York City. Paul Allen is a Microsoft billionaire. He owns the Seattle Seahawks and the Portland Trail Blazers. These guys have all committed to giving the vast majority of their wealth, hundreds of billions of dollars collectively, to philanthropy or to charity. You don't have to be a billionaire to give back. So we hope you're successful. We hope you have some money to give back. We hope you've got a great family and a great financial situation for yourself, and we hope this course has helped you get there. And my last final quote with Mr. Buffett will be that you look at this shade tree and you think about your planning and how long it took that tree to grow. And he says that someone's sitting in the shade today because someone planted a tree a long time ago. We hope when you're young in your life, you'll plant a tree, nurture it, and let it grow because we want you to be successful your entire life. We hope you've enjoyed the course. We hope these things have helped you, and we hope you're going to be wildly successful. Thank you.